good morning. You're watching the market right here on 80 now, and it's almost seeming like we're opening a new Pandora box every morning. All that transpires overnight while you were asleep, and clearly there is contagion fears, and that's really real when it comes to the global banking sector. Very quickly then, in a glance, the dollar index overnight has shot up about 1.25%. It's now hovering around that 104.6 mark. Brent crude is now at December 2021 lows. We're hovering around that $74 per barrel mark, and the US 10-year yield has fallen further, about 22 basis odd points or so. Now, here's why there is fresh turmoil in the world, because Credit Suisse, the stock has nosedived about 24%. Saudi National Bank ruled out more cash inclusion into it. The stock managed to hit an all-time low for a second consecutive day. Regulators are saying, though, now that they're going to be providing additional liquidity if required, and the bank has been meeting their capital and liquidity requirements. They are going to borrow up to about $54 billion. That said, you've seen a fair amount of volatility in not just Credit Suisse, but across the global markets as well. But we can't sugarcoat this environment at all. I mean, I'm just looking at the Asian screen. We're down almost 1 to 2% across the board.
Look, it's not like a scary sell-off, but the fear of unknown is a risk, which I think is a real risk. If in my book, the problems from American bank, they've shifted to European bank. In America, the problem was regional. It happened with regional banks. Credit Suisse is a global bank, both in terms of the global linkage and both in terms of the balance sheet size. So frankly, the problem in America versus the problem in Europe, the problems in Europe are far bigger than the problems what were there with the regional American banks. That's one. And that in a sense is injecting some nervousness and a lot of volatility. So it would be impossible to connect the dots at least this Thursday morning and talk about why gold is up and why bond markets have seen a roll. The bottom line here is that financial asset markets or financial markets are going through a stress test. Very difficult to say that how and what could be the extent of collateral price damage. But one thing I can certainly say is that when you see a news and a headline, you will be in for a stomach churning volatility. Prices will be moving both on the up and on the down. You will not be able to draw any kind of an linear correlation. So in this market, you simply do not want to be actively trading, because the price action is going to be both ways. We went home yesterday, SGX was down. We are starting this morning, despite the Credit Suisse news, there is a print of green on the SGX. So it's going to be gut-wrenching and stomach-churning volatility. But the problem has moved from a group of American regional banks to a big global European bank, and that is a much bigger problem in terms of magnitude and in terms of collateral damage it could have.
But I wonder why then the sentiment here back home in India is getting that brittle.
Aisha, foreign institutional investors have been selling. Typically, markets have not given you great returns in last 18 months. The retail sentiment really has been brittle, and HNI investors have lost money. So the appetite to participate in this kind of an environment when the headline is poor and the price action is also very fragile, I think is not going to be there. So nobody really wants to participate because everybody is waiting for clarity and to understand that where the light at the end of the tunnel would be. The best approach in this market is that while the temptation to go short because of the breakdown in Nifty is high, I think one should not do that because it's not going to be a linear fall, one. B, I don't think we've reached that point where you would say the markets are cheap at all. I would say that let the market settle down. It could be a week, it could be 15 days, it could be 3 weeks, but in and around earnings season is where you will see markets coming back. What do you buy in this market? You should buy domestic dominated sectors because they are the ones which would be in a sense bulletproof with what is happening in the world. So somewhere on decline, you will have to go back to banks. Somewhere on decline, you will have to go back to domestic consumer names. Somewhere on decline, you have to accept the fact that commodity prices are down, crude is down. So the fear which was centered around inflation will automatically start get adjusted. You don't know what will happen to FIs because there is a compulsion which is at play. I mean, why has Reliance fallen 2% yesterday? I don't know. Was there anything specific against HUL? Nothing. But it was in compulsive FI selling which is having impact on the markets. So if there is more unwinding, FI dominated stocks will remain under pressure, and I think that's clearly visible.
And not just that, linkages to companies which do business in Europe. I mean, I was just going through the list. Samvardhana Motherson, for instance, a Precision Camshaft, even Infi, TCS, Tata Motors, Emphasis, some of these small IT companies are bound to get hit.
That's how markets would react. But remember, markets know the playbook. We've reacted to this we've seen this kind of an environment when everybody, let's say in 2015-16 and 16-17 was talking about blow up of the European nation. That was a far bigger problem than a bank like Credit Suisse. So markets know that what happened when the European economy went through the stress. The point now is that at what juncture the compulsion in the market really finishes, because in the near term it's about sentiment, it's about compulsion, it's about what fund you have, what kind of redemptions you have to deal with. So when typically you see so much of news, and suddenly when the news is about systemic risk, the market gets into a freeze mode, it gets into a numb mode, and the buyers would be on some kind of a strike, and the sellers would be forced to sell, and they will disregard price. So you are in for a sharp volatility, lower prices, and serious price damage. You want to be a buyer there, but I don't think we've reached there.
Okay, let's also bring on board Arvind Sanger then to put all things into perspective. He's managing partner at Geosphere Capital Management. Arvind, good to have you on board. Clearly, with all the news now spewing with Credit Suisse, it seems that the investability of financial institutions really seems to be seeing a huge question mark.
Well, I think it's a little bit of a risk-off time, as you guys were just discussing. I mean, it's time for risk-off till we figure out what's going on. But I think the reality is this. Look, till now, the Fed and other central bankers have been raising interest rates. And the assumption has been that the economy is proving extremely resilient. Remember, a month ago, we were talking about how strong the economic rebound was at the start of 2023. And now what we are finding out is that the stresses were somewhere else in the system, and the banking system is showing the stresses of this very rapid rate increase. So I think look, I'll be honest, I'm not a believer that there were no lessons learned from 2008. Therefore, I think that the banking crisis is not going to be a meltdown. It will tighten financial conditions, which means loan disbursements will slow down, which means people will be more reluctant to spend as they're trying to protect their capital and move it into safer havens. So therefore, the economy is slowing down. And the reality is, if it doesn't happen, then the Fed is going to, and other central banks are going to start raising interest rates. So Goldilocks is dead. It is either a recession because of this banking tightening of conditions, or if the conditions don't tighten and we rebound in the next few days because Fed and ECB take a pause, then Fed and ECB are again going to start raising. So in any case, I think there is no benign case here that can happen without inflation coming down meaningfully.
So Arvind, are we looking at then more price dislocation? Because if the construct is that either we're headed towards recession, that's bad news for equities. If you're not headed towards inflation, then Fed will continue to fight inflation. That's even bad news. Bottom line here is that equities are headed lower.
I think equities are going to be in a range bound. I think the question is going to be how much of a slowdown do we see, and how quickly does it play out? And at what point, now people are starting to think about, at what point do central bankers start lowering rates? Because you're seeing, in a sense, you are seeing QE, right? With the Fed buying taking on loan securities, discounted securities, these government bonds at face value from the banks, and now the Swiss National Bank providing liquidity to Credit Suisse. We were in the middle of tightening in QT and the quantitative tightening, and now we are in the middle of QE. So I think that the market is a little confused as to what comes next, and so therefore I think the prudent thing is markets are probably going to stay range bound with maybe a slightly lower bias till we get clarity on how deep and how quick does the recession play out.
So Arvind, the fact that crude prices are down, metal prices are down, the recession talk in a sense has already led to not a massive but a mini sell-off in the commodities. Do you think that is something which we need to be cognizant of? Because ultimately inflation is a function of dollar index and commodity prices. At least one story, at least one problem is getting addressed.
Yes, it is. But I think the final chapter on this issue has not been written, because the China reopening trade can easily, depending on what China does and how quickly it does it and how much it does, can easily offset. Because remember, China is the giant. It consumes 50% plus of the world's steel, copper, aluminum, zinc. It is the dominant player. So therefore, when we think of commodities and we think of past recessions, we don't have this construct that existed before. So therefore, I think that at the end of the day, this is very much a US and our European problem. China's export industry will see some spillover into that. But there are other parts of China which were in lockdown last year, significant parts of the domestic economy that could revive. So I think the commodity market has some legs. And I think, gold, to be perfectly honest, is one of the areas that could be very interesting going forward. I think, we have to look at the fact that we are in a dislocation period and interest rates are not going up.
I'm just going to take a leaf, Arvind, out of what Uday Kotak just tweeted 6 odd minutes back. And he's putting the India backdrop. He's saying that even as the global turmoil continues in financial markets, the macros are turning better for India. I mean, the current account deficit is now looking below 2.5% for the fiscal, going below 2% for FY24. Lower oil clearly helps us. We're at almost 73 now on the Brent. And if we walk our talk and navigate well, he says India can stand out in this turbulence. And I really want you to tell us where you think India markets could be headed, because we are coming out of a very long patch of underperformance given what US equity markets or the Far East was doing. Do you think India can show resilience as it did a year back?
I think India could benefit from this, lower commodity prices, lower inflation. And India is one of the lesser export dependent. Look, India is not immune to global growth, so let's not get carried away too much. India has, export dependency and global connectivity in terms of both capital flows and in terms of. But India, having said all that, is one of the most amongst emerging markets, inward-focused, domestic-facing, service-driven economy. So therefore, all of those factors provide for India a better backdrop than most other markets. So I think it certainly can be a relative outperformer, and maybe even absolute if the domestic story plays out well in terms of domestic demand, in terms of domestic spending, in terms of domestic consumer confidence. If all of that plays out and inflation comes down and RBI doesn't have to do much more, that would all be good. But, I'll tell you the negatives for India. We're going into summer. I think there's going to be significant challenge on the power side. I don't know what the weather is going to look like. I don't know whether we'll have a good monsoon. So there are monsoons are maybe not as important, but there are challenges in the short term in the Indian economy, but they're not quite as painful or as significant as the challenges facing, the West certainly are.
So, Arvind, would you be looking at increasing your India exposure? Would you be looking at buying? Maybe it not dip. By the way, Peter is getting ready also. Peter, I'm just coming to you. I'm just going to read about the cricket match scorecard. India vs Australia, one-day match coming up. I'll talk to you about it. But I'm going to ask one question to Arvind before we wrap. Arvind, if I look at India's positioning, we are standing tall. And once the dust settles down, 5% lower, 10% lower, nobody knows what the extent of the price dislocation would be. Would you say that disproportionate amount of money will automatically start coming back to India, largely because of the appeal, largely because of what's happening in the world, and largely because of the construct?
Absolutely. India is one of the places where growth is going to be much more safer to bet on. And I think India will be one of the beneficiaries of this global dislocation.
Really appreciate your time. Thank you for joining us. Well, we've got Arvind joining us from New York. Peter joins us all the way from Australia. And that's what the attempt is. We're trying to get you as many...
The entire globe.
Cover the entire globe. Yep. We need to... it's so much global in nature that one side you could say, if Fed increases rates, it's actually good news because that means Fed believes that the banking system is stable. Banking system can absorb that shock. If Fed is not going to increase rates, that means that the Fed is scared that, oh my God, The system is breaking down and the system is not able to digest any more rate
the
hike.
hike.
So really, depending on whom you want to argue, what you want to argue, what your positions are, you will get a different kind of an answer. Commodity prices coming down.
The markets would be happy though if Fed pauses.
Yeah, I would no. Markets would be happy if Fed increases rates. See, the collateral damage by 25 bips rate hike is not going to be large in terms of the demand and other factors. You know, for 4 becoming 4.25 or 3 becoming 3.25, the collateral damage is not large. But the signaling that the Fed has got everything under control, I think is far more important. See, what is the worry in the world? The worry in the world is not demand or recession or inflation. It is about the systemic collapse. That is something which only the regulator can endorse. I mean, only the regulator can come out and say that the fear of one bank going belly up, second bank, not going belly up, that the regulator has to come out and
How
say.
things have changed. A week back, we would have said that, yeah, Fed is going to be, or other markets are going to be happy if the Fed pauses, but now things are completely different.
Peter, good morning.
Morning, Naraj.
How are we doing this morning?
We're doing pretty good, thank you. It's sitting here, and I'll tell you what, there's no shortage of opportunities, Nikant, in not only the commodity complex, but the currencies have been incredibly volatile over the last 24 hours.
Peter, the sequence of events is quite reminiscent of, let's say, what we saw almost 7-8 years ago when we were talking about collapse of European economies. We're talking about Greece, Portugal, Italy, Spain. We're talking about banks blowing up now. So do you think this is just the tip of the iceberg? Rather than looking for opportunity, it is important to run for cover, hide for shelter?
Well, whether it's the tip of the iceberg, it's certainly from a global contagion mindset. The Credit Suisse situation is very worrying, and whether this could wrap itself around European banks. So as we sit here at $2, I'm looking here, it was down 24% for Wednesday. And you're looking at a 50 billion rescue package from Swiss, that's in Swiss francs, from the Swiss National Bank. So I sit here and I hope that that's enough support to re-engage Credit Suisse, but it's just a wait and see proposition, and how that rolls across to decisions from Fed Chair Powell, from central banks moving forward with rate either hikes or putting the foot to, taking the foot off the accelerator. These are all unknown and uncharted territory, but there's a lot of similarities, as you said, going back 8 years or so. And in some ways, it's possibly going to be similar to 8 and 9.
Peter, is there a major now worry in the markets that we could see this contagion effect spilling over to the overall global banking system?
Yes, I think so. I think from what I read and what I take on board, yes. And I think that would be political, so the politicians, that would be significantly a great concern to the likes of the SEC, to the likes of ASIC, to the likes of the regulatory bodies out there, what's going on, and looking at, this is an hour-by-hour proposition. You don't like seeing the start or the mindset that banks are in a weakened position. So yes, you've got to stem that, you've got to soften that, and you've got to make sure that there's confidence across the retail sector and, of course, from the commercial arms of banking. And all of those, that sentiment needs to be really a top-down approach from not only regulators but politicians, saying that everything's okay. And I think that's where we're at the moment.
What about the outlook now in terms of how investors will really approach this? Do you think there's going to be now a force or a race towards safe havens like treasuries? What's going to be the view in terms of the expectation that the market will be pleased with from the US Fed Reserve? As we were saying, perhaps a mild hike would be the preferable option.
Well, Nakunja's argument, just as he was introducing me, yes, I do take that on board, that maybe, I don't think 25 basis points is going to really impact the psychology of the market too greatly as far as the Fed was concerned. So that might be a thought there. And what that does naturally to the US dollar, and where does, the likes of indexes, what happens to Wall Street. and the overall picture globally with equity markets. And naturally, you roll that across to bond yields, currencies, commodities. Look at copper yesterday, down nearly 4%. Gold's still sitting at that 1915 sort of handle. I'm looking on the screen now, about 1915. So, yeah, there's big moves out there, big volatile moves, and that's a good thing if you're a trader. But yeah, I don't know if central banks like it.
We can keep guessing that. Hopefully, things are going to disclose soon. Peter, great to have you on the show. Thanks, as always, for taking the time out. Let's just see what the market constructed is going to look like. And let's just bring up the SGX Nifty. Once again, it's indicating a bit of a tempered and stable start. Well, who knows which way the ship is going to rock. So let's bring on board Kunal as well as Naresh and find out what their reading on the charts is. Kunal, hi, morning. What's it looking like? A quiet start and then again a tumble?
Yeah, let's not hope the second half, but the second part. But then I think it should be a quiet start, and I would probably expect to be a more stable day for the index than the last couple of days, because last 2 days, specifically yesterday, where there was an initial attempt for the indices when it opened up on the higher side, and then we managed to go into a correction in the last half an hour, last 1 hour or so. Indicates that there was weakness as well as volatility which had come back into the indices. But then our market seems to have factored in what could probably actually transpired for majority of the global markets yesterday, and that's why the even the reaction for the SGX 50 throughout the evening yesterday was limited towards just 120 odd points. At a point when Dow was even down by more than 700 odd points, and the European indices were more than 2.5 to 3% down. So I think major part of the impact seems to have been factored in for our markets, at least for today. So I would probably expect to be a more calmer day. 17,000 I think broadly could be a pivot for the index, and we could probably hang around maybe 100 points plus or minus that 17,000 mark. The only factor which I probably would now keep a close watch on would be India VIX, because now we are coming very close towards breaking the 200-day moving average, and historical precedents for India VIX breaking past about the 200 DMA and sustaining about those levels for 3 consecutive days have not been resulting into positive actions for the indices. So that's, I think, the other key factor to watch out for. Hopefully, if we don't cross back about the 200 DMA and if we settle at this range of 16 or below, then I think the volatility should ebb off significantly.
All right, Naresh, let's get in your take on the markets as well. Given all that we've been handed over from the global markets, the fact that yesterday we slipped below the 17K mark, what is it that you're penciling in by way of levels?
So in terms of level, that 16,750 to 16,800, which has been the low over the last 1 year, that should act as a support. And same case, we are looking at a support which is a little lower on the Bank Nifty, but what we are looking at is yesterday also, even when the markets dipped in the second half, we did not see a very sharp cut in the broader markets. So that tells you there is a lot of resilience in the broader markets as well, and stock-specific opportunities could continue. It's only when we start breaking below 16,750 levels on a sustainable basis when the trend changes more towards a totally negative side of it. So for now, I would expect a new range being found, which is basically 16,800 on the downside and say 17,600 on the upside.
Okay, let's find out those individual stock strategies as well. And Kunal, what is it that you're picking out for the day?
So I would suggest a couple of buy calls over here, going a bit defensive in terms of the kind of stocks. So the first one is one, Kotak Bank. Apparently this stock has stopped falling aggressively and is taking support at the 1650 odd marks. So keeping 1645 as a stop loss would suggest one, Kotak Bank. Targets to be kept at 70.25. And the second would be one, IEX, a stock which we've been discussing earlier, that how the stock has confirmed a breakout of its 200-day moving average. This is at a time when the markets are going through a sharp correction. Momentum, volumes, chasing the stock price, all of that is quite positive for IEX. So would suggest a buy. 158 to 160 could be a target range. Stop loss at 148.
Right. Naresh, what about your stock ideas?
Continue to be defensive yet again. So first would be a buy on HDFC Bank. Now the stock has corrected from the recent highs of 1700 down to 1550. The last big tick we saw on the stock was that big gap up day. On that day, it went from 1550 to 1600. The gap around that area is 1530 to 1550. Yesterday we've tested that gap. So ideally this is a gap which should hold. And from here there should be a bounce back. If this bounce back happens, it could go back to 1650 levels. So the risk reward looks interesting at these lows. A stop loss at 1500 and a target price of 1650. Second is a buy on Power Grid Corporation. Now, the stock has been a slow and steady rise over the last 1 month, even if the markets have corrected. Now, the stock is making a flat pattern between 224 to 230 levels. Once it sustains about 230, it should be a quick move towards 250. The stock is barely away 3% from an all-time high on a dividend-adjusted basis, so clear outperformer in current markets. Expecting this to break out over the next couple of sessions and make a quick move. A target price of 250 and a stop loss at 220.
Right. Okay, and the current market turmoil will not be as bad as the global financial crisis, believe market experts. Shankar Sharma sees good opportunity in the fixed income market as in select mid-caps, while Sandeep Tandon is betting on value themes like metals, power and PSUs. He believes that India is much better placed despite volatility. Let's listen in.
Is you're not going to get a broad bull market. I don't think any of us should hold out hope that we are going to see a broad bull market in India, that is anytime soon. We are going to see very patchy markets in which a reasonable part of the markets will be flat or even down, while small pockets of stocks, whether in the Nifty or below the Nifty, will be doing well. And that's really the skill of your investment acumen will be tested in this year.
Any such corrections, are seen or should be seen as an opportunity to invest. And in 6 months, whether it is 3 months, 6 months, nobody knows. But definitely these are very attractive points. India story continues to remain. In fact, our interest rates are not in a dangerous territory. In fact, as inflation settles down, which I think is a matter of time, whether it is 3 months or 4 months, I think we have already seen the peak, and slowly you will start seeing only coming down. There could be case made for Indian interest rates coming down. Whether it is again 6 months, 12 months, I don't know. But Indian economy is on a solid path. And slow down of 1 or 2 quarters always happens.
If I have to look at 2023 now, yes, it will be volatile, but if we can say with good amount of confidence the top is in place, so answer is big no. Okay, because the characteristic from a behavior perspective, what we look at from a various conditions and euphoria which has happened across all the street has not happened. Okay, which means that if I have to look at larger perspective, you will see again all-time high as early as maybe in the last quarter of 2023 or maybe beginning of first half of 2024.
So Indian market is actually a wealth creating market. So you should not be perturbed by so much of this volatility, because that parts and parcel of equity investment. But if you are a long-term investor, definitely equity as an asset class will outperform bonds. And I feel that this is what one should look at. Secondly, India is in a sweet spot with respect to the GDP growth, with respect to the equity market, with respect to flows.
Welcome back. Staring at a pretty choppy screen for the Asian markets, although the US futures and the SGX Nifty have managed to rise after that pretty choppy move. But moving right on then, the Reserve Bank of India's Governor, Shaktikanta Das, has been awarded the Governor of the Year award by central banking. The Reserve Bank's former governor, Raghuram Rajan, was conferred the title back in 2015. Remember, Das has helped maneuver the ship as it faced multiple obstacles in his appointment, the COVID-19 pandemic, the Russia-Ukraine war being the two major tests. Central banking has said that the Reserve Bank has made judicious use of its reserves to cushion the impact of major shocks that India has faced. But how will the global turmoil that we're seeing impact the Indian Central Bank's policy making? Let's listen in to views of S.K. Ghosh, the Chief Economist Advisor of SBI, on what the chaos means for the Indian banking system.
I think there are serious methodological issues with the current CPI basket. Unfortunately, these issues have not been addressed for whatever reasons, and that is actually also playing a spoil sport in these CPI numbers. But even if I keep aside and assuming that all is good with the methodology, my sense is that after some point of time, given the fact that monetary policy works with long and variable lags, we may have to give time to the past rate action to percolate through the system to have a meaningful impact on demand. If we take the example of Fed, the Fed actually has been trying to push up inflation so that the demand declines and then it can pull down inflation, but it has not succeeded. The past rate hikes are still working through the system, and maybe it may be a better idea to allow them to work through the system and then see where does the inflation stand. Otherwise, what is going to happen is that suddenly now we are seeing a constellation of forces which is actually pulling up the credit growth a little down, and suddenly we could see that all these constellation of factors working together to have a sharp impact on the future growth trajectory. Reserve Bank as a regulator has been extremely proactive in terms of warding off any contagion. If you remember what happened in 2008, what happened in 2020 in terms of some news impacting some of the banks, and the Reserve Bank was immediately on the ground asking other institutions, the other larger institutions, to rope in and help the beleaguered institutions. And I think that had an immediate salutary impact. I think that is one of the factors which the US could actually learn from India in terms of how to use a collaborative approach to ward off and contagion, because that's the best policy option. The characteristics of the Indian banking system is that Indian banks depend more on retail funding rather than wholesale funding, which has been which is not the case in other developed economies. And retail deposits, as you know, actually is more than 90% of the total banking sector liabilities. So that actually makes our banking sector unique and insulated to the global developments. But of course, in today's world, you will see that the stocks and the financial markets getting hammered because of this negative news. But our sense is that there has been absolutely no banking failures in India since independence.
Well, oil prices, they too are a big talking point this morning. They've settled at the lowest level in more than a year on recessionary concerns triggering a demand cut. Soumit joins in with more details on the price action in crude.
Well, if you see, the Brent crude prices have fallen below the $75 per barrel mark, which is the lowest level, or for the first time since 2021, since its recent peak of around $86 per barrel. Crude prices have fallen by around 13%. Now, what are the reasons behind this? Firstly, is the recessionary concerns globally, and second is the fact that OECD inventory has increased and it stood at its 18-month high and at 5-year average, which has again led to higher inventory and supply concerns or supply outweighing demand concerns on the market, because of which the crude prices have fallen. Now, what is the impact on the Indian economy? Now, given the fact that India imports nearly 85% of its crude requirement, every $10 per barrel drop in crude oil prices positively impacts the capital account deficit by around 14 to 15 billion, which is around 0.4% of the GDP, and also a $10 per barrel drop positively impacts the retail inflation or lowers the retail inflation by around 50 to 60 basis points, while the wholesale inflation comes down by around 125 to 135 basis points. Companies and sector-wise, the oil marketing companies, it's a mixed reaction because of lower crude oil prices. The marketing margin increases. Now, according to analysts, $1 per barrel drop increases the petrol and diesel margins by around 40 paise per litre, but it also negatively impacts given the fact that OMCs maintain an inventory, and a drop in crude oil prices leads to inventory losses. When it comes to oil explorers like ONGC, Oil India, Vedanta and HOEC, it's negative because lower crude oil prices means lower realizations. This, coupled with windfall taxes, is expected to put further pressure on the realizations of these oil explorers. Other than oil and gas, there are a host of sectors that get impacted. Firstly, paint, nearly 40% of the raw material is related to crude, so if a lower crude oil prices benefits the margins. When it comes to aviation, again around 40 to 45% of the total cost is related to fuel cost, and a lower fuel cost will definitely positively impact their EBITDA. When it comes to tires, synthetic rubber, carbon black and other chemical prices are related to crude, which forms nearly 40% of the raw material basket. In case of cement, also nearly 40 to 50% of the total cost is either directly or indirectly related to crude. Now, a host of specialty chemical stocks also get benefited because they are key raw material prices are related to crude. Name of some of the chemical companies are Balaji Amines, Alkyl Amines, Camlin Fine, Clean Science, Rosari Biotech, Deepak Nitride, Vinati Organics, Meghmani Organics, Nosal and Aarti Industries.
All right, thanks very much for giving us all of those details. Let's also bring on board then Dipan Mehta, who's joining in on the show. Dipan, hi there, good to have you. There's nervousness and volatility across the global markets. Every day it's a new headline that's bombarding the screen. But what's your latest take on what the ripple effect of the Credit Suisse news could mean for global banks and, of course, for back home? Is there a fear of contagion?
Good morning and thank you for having me on your show. I think again we are in a classic risk of trade, and problems globally are having ripple effects or causing waves over here in our markets as well. And clearly I think there is no impact on the domestic fundamentals. In fact, I heard your report on oil prices and how beneficial that is for our economy and corporate earnings. And yet you have stock prices correcting because of relentless selling coming from the foreign investors. And this is a pattern which we have seen has played out several times in the past, back in 2008 and 2000 as well as 12, 13. And my assessment is that we just need to ride out these turmoil times and just stay put. Eventually, I think once stability returns in the global markets, and again, India will start to outperform, and I think it will do with a huge margin this time around. But for the time being, I think, it's very difficult to say when all this will settle down and when the markets will bottom out.
Okay. So, Dipan Mehta, one has to talk in terms of sports or cricket terminology. If one has a T20 approach, what is the best way? And if someone has a test match approach, what is the best way to approach this market? Test match gives you time, T20 does not give you time.
Yeah, well, T20 also is a bit of a game of luck as well. And from a T20 perspective, then you have to go for the momentum stocks. These are great trading opportunities as well in the markets. And if you're a good trader and able to cut your stop losses, then there is the entire Adani group of companies and some of the other highly, sensitive stocks which have very high alpha, go up and go down at least 7-8% in a day. And that does provide an opportunity if you were to compare it with the T20 approach. From a test match perspective, yes, I think this is a good time to start getting into some other contrarian bets as well. And some of the existing stories also which have done well, sectors which have done well, where prices have come down, you could look at those sectors as well. From a contrarian perspective, yes, I do understand that software companies have been beaten down. But I was quite pleased with what LTI had to say in their recent investor day, and that does inspire confidence for the stock as well as for the sector as a whole. And then we had this KPIT news as well, where they got the order from Honda, and it's supposed to be quite a major contract for them. So maybe, if you have a longer term view, 2, 3, 5 years or so, and the way the software companies are trading at, even some of the mid cap ones, the high flyers, their also valuations have come down to reasonable levels. So you could look at increasing your exposure to software companies, the ones which have been outperforming in terms of financials over the past 3-4 quarters or so. And maybe you'll get rewarded pretty well over the next 2-3 years or so.
Now SGX, the word muted start, I think is good news actually. Trust me. A little bit of green also these days, we start getting happy about it. Right, Kunal? 20 पॉइंट चलो 20 पॉइंट तो है ग्रीन होना चाहिए 20 पॉइंट है बस करेक्ट दैट इज इंपॉर्टेंट राइट इट्स नॉट अ फ्री फॉल
it's not a free fall. As I was mentioning earlier when you were not there, that I think we've seen extreme amount of volatility in the last 4-5 days, specifically yesterday and day before, where there were 2 days where there was slight attempt from the bulls to try and make a clawback again. But then, the markets at the end of the day or on a closing basis, we gave up most of the gains and we closed on a negative footing just on a day like yesterday, for example. So I think after such a kind of a reaction across the globe, a recovery for the US markets, for the European markets, as well as a mild bit of start from the SGX 50 would probably indicate that we could be into a stable day for the indices, and that itself could be a good relief for the traders, because after seeing such a kind of heightened volatility, if the index remains in the range, a very confined kind of a range, maybe 100 points plus or minus 17,000 mark, that itself could be an indication that at least you can now try and proportionally try and pare down the risk from your portfolio rather than doing a very sharp adjustment towards paring down your portfolio risk.
Kunal, you were perhaps one of the first to call out that the market is looking brittle, it's going to fall further. We've fallen 10% from the top already. Officially, when is it that you get into bear market?
So technical definition is 20%, but ideally the level which I'll keep a watch on would be 16,500. That's a level which has a very historical strong precedence on the index movement, because that's a level where I would believe that the downside on the indices or the floodgates for the index would probably open up significantly, and we could be looking at a further sharp correction of maybe 8 to 10% further from those levels. So I think the most important level after 17,200, which was a major support till last 2-3 months, has to be 16,500. So anything in between is where the index can just go into a volatile phase. We may close up, close down.
Do you think we're going to reach 16,500?
Let's hope not.
So you mean you see it on the cards already? Okay.
Okay, meantime, Reliance Industries, we've been tracking that counter. Just pull up the 5-day chart, and that stock has steadily fallen from those 2,400 levels now to about 2,237. Let's get in a view, Nuresh, from you. Basis the chart patterns, what exactly is the move on RIL indicating?
So it's a little tricky situation here. So the low in September as well as in January, February was around 2,300. Bounced off it a couple of times. And now we are testing the next low, which is the major one, which is back in February, March, when the Russia-Ukraine invasion started. That is the time it actually spiked from the lows very sharply. That time the low was 2180. And then we go back a little earlier, in the top in September 20, which is where the whole fundraising happened. The stock was the best performer, the first one to take it off. That time the high was around 2250 to 2300. Now we are in this band of 2200 to 2300. Which becomes a very important zone. But technically, over the last 6 months, the trend is breaking 2300 has shifted the trend on the downside. And now whether we stop at 2180 to 2230 is the thing which I would watch out for. But overall, the main shift in trend would be whenever it starts sustaining about 2430, 2450 levels, which is the top it made in February. So for now, the trend is down. But once it starts sustaining about 2400, that would be a reversal. So for now, it is still a negative zone.
Okay, while it was sure a bloodbath on the Swiss-based global investment bank and financial services firm Credit Suisse, all banking stocks followed CS's lead and led the markets to a decline. However, let's try and understand what the India impact is. How much of the business does Credit Suisse generate in India? What's the linkage here? Pankaj has been doing some interesting analysis. He joins in with the same. Pankaj?
Well, thanks for that. When we look at Credit Suisse, the big talking point has been what is Credit Suisse doing? What is the impact? Now, what we have tried to do is speak to analysts, look at various reports and try to find out what is the impact as far as India is concerned. So Jeffries, to start with, says Credit Suisse India is more relevant than SVB as far as total assets in India is concerned. Remember, Credit Suisse is also a bank in India. They do have one branch. We'll talk more about it. Credit Suisse has assets worth about $200 billion, 200 billion rupees in India. So it's not particularly very, very high. Overall, foreign banks have assets of close to about 5 to 6% of the system, of which it is about 1.5% as far as Credit Suisse is concerned. As I told you, overall impact is very, very limited with respect to about 0.1% as far as total banking assets are concerned. So it's decently small when you look at the size. Now, when you just look at the size on two parameters, one, within foreign banks, it has about 1.5% market share in India, and within the sector, it's about 0.1% as far as the overall sector is concerned. But there are some key concerns which people have pointed out to, specifically Jeffries, and they are saying that there could be certain liquidity issues if there is any problem. There could be a rub-off of counterparty risk because they are very, very active as far as derivatives markets are concerned, specifically in up to about 2 months' time, or the shorter frame time as far as derivatives is concerned. They are very, very active over there. Deposit market may move towards larger and quality bank. They do not really see a big run on deposit, but they do believe that they could move towards slightly higher banking names, and that is something which they are highlighting as could be the near-term thing to watch out for. As far as their India presence is concerned, they have only one branch in India. They are the 14th largest foreign bank in the system. Close to about 60 to 70% of their assets are into GSECs with absolutely zero NPA that they have in India. But as I told you, their overall share is 0.1% of assets, very, very limited as far as India is concerned.
All right, that's Pankaj summing it up for us. As far as the India impact is concerned, as he said, it seems to be fairly limited. But let's also get in a take then from some top global voices, the likes of Mohammed El Arian, Nuriel Rubini, etc., giving us their global commentary on all that's brewing. Vinny joins in to give us a snapshot of that. Vinny?
Absolutely. Mainly the highlights that are coming in is because of the SVB bank fall, while as in terms of Credit Suisse, also the concerns going around there as well. And let's talk about the first commentary we have is coming in from Nuriel Rubini. And what he's talking about is that, the ECB will be making its decision in terms of the rate hikes today post-market hours. So if they actually hike the rates by 50 basis points, then that will be a concern coming in for Credit Suisse, and it might go bust over the weekend as well. And then ECB will actually have to reverse itself in terms of the rate hikes if they take any by the next week as well. So he's hopeful that it will not repeat the mistake that it made in 2011 during the crisis that happened over there when it hiked the rates that time as well. Now moving on, Mohammed Al Narian also spoke about the three main factors that are actually impacting the current market turmoil. The key highlight that he's giving in, the first one is the mismanagement that has actually happened in terms of the individual banks over there, as well as the supervisory lapse that we've seen coming in. Other than that, badly and mishandled monetary policy transition, which is conflicting and complicating insufficient public as well as private sector adjustments as well. And lastly, he's highlighting the policy induced volatility, which is amplifying economic as well as the financial fluidity as well. So these are the three major points in terms of impacting the current market turmoil is the word coming in from him. And lastly, let's talk about Scholz, who is a European banking analyst at Morningstar. Individual commentary coming in there, he said that the Credit Suisse might no longer actually have any funds and absorb the losses in 2023 because the funding costs were becoming more prohibitive. So these are the words coming in from the top global voices.
And all I can say is that market narrative keeps on changing. 1 month ago, it was only Adani. The world was looking down at India as if, Adani sell-off in Adani group of stocks will break down the India story. Then last week, it was only SVP. And today, it is only Credit Suisse and what will happen. Nobody is talking about Adani. And that's how markets have moved on. And that's how typically markets move in terms of a narrative. Depen, what is the best strategy in this kind of a market? Because ultimately you know that this shall also pass. I mean, if the system does not blow up 3 months from now, 6 months from now, when we will analyze March of 2023, it will look like a great buying opportunity. How do you keep calm? How do you say that, look, I'm going to do the right things without looking at all the headlines?
Yeah, Nikunj, I think experience plays a very important role over here. And I think when anybody has seen what happened in 2008, you can pretty much say that you've seen almost everything that can happen in the market, because those were really fearful times. And this seems like a walk in the park compared to what we had to experience at that point of time. And India has moved on way, way ahead from those times in terms of retail flows, in terms of government reforms, and in terms of overall corporate earnings and corporate governance standards. So you just need to keep calm, and there will be opportunities. This is a very relevant question which you have asked. And all that we are doing is looking at all the outstanding businesses which we could not buy in the past few months because of very high price to earnings multiple. Now, I think if those businesses are coming in at reasonable valuations, then that's a good opportunity to get an entry into a great business with a 3 to 5 year type of a perspective. And that will happen not just because stock prices have fallen, but also I think if you give 1 or 2 quarters, then these numbers also will keep on improving for such outstanding businesses. And you will see that a stock which was going at 60, 70 times trailing 12 months is suddenly available at 35, 40 times trailing 12 months. And that would make an interesting entry opportunity if you are convinced that this company can perhaps double its profits over the next 3 years or so. And if you identify such companies and buy them with patience, then this entire phase could be extremely rewarding for you.
Okay, let's change gears and talk about where SGX is. Are we in for a very scary fall in first thing this Thursday morning? The answer to that could be no. I just want to bring this, whole aspect of markets in terms of where the performance has been. Last 1.5 years, the market has given no return. Before the crisis in the US regional banks and the Credit Suisse issue, the market was very numb and dull. The desire to trade long was missing. Positions have been on the low side. FIs have been selling. So there is no large mass euphoria in the market. I mean, typically the collateral damage is much, much higher when there is a mass euphoria in the market per se. Dipin, if I look at the FI dominated stocks, would it be a very easy answer to say that right now the near term challenges are global and you should avoid into all stocks or any stocks where FI domination has been high, IT, banks, consumers?
Yeah, I think you could take that assessment, but these days FIs are not as much of a force as they were a few years ago. And our local mutual fund industry also, their buying patterns, their stock selection is very much similar to what the FII's choices are. So, when it comes to identifying businesses in terms of buying or selling, I don't really look at what the FPI percentage holdings are. I'm more focused on the price to earnings multiple, price to book, and whether I'm getting a good quality business at a reasonable valuation. I think we all know that's the mantra to making good returns in the stock market. And as investors, we remain focused on that particular strategy and not be too concerned as to what the ownership breakup is at this point of time.
Meantime, some stocks that will be in the news today, as we highlighted, Samvardhan Motherson, the holder Sumitomo Wiring System, has offered about $230 million, and the deal size, we understand, is close to $195 million, with a floor price at 69.9 rupees per share. We'll also be watching out then for an Orient paper. There's some capex plans that have been slated, about 475 crores. This is for modernization and debottlenecking of one of their facilities in MP. That's Orient paper that I'm talking about. And Indian Oil as well. They want to raise their renewable capacity to about 200 gigawatts by 2050. So this stock as well is going to be in the spotlight. Let's get in a view then on the charts. Naresh, Samvardhan Motherson and Indian Oil?
So Motherson is again a stock which has been in a downward trend, not really looking at it in a close, say, wave, because it's been post the say exercise of demerger or something which happened. The stock has been in a downtrend, so not really looking at it. As of now, no view on the stock.
What about Oil India?
Oil India is the interesting one. So if you look at what has happened in the last few months, is Oil India has been an outperformer. The stock, say, was around 200 levels in December. It's been making higher tops and higher bottoms. And the recent high is 270. That's a good 30% move on the stock plus. And yesterday also the stock reverted back from 240, 45, which is the last low. So classically making higher tops and higher bottoms. I would expect the next move to be closer to 290, 300. So still a buy at current levels. The relative outperformance as well as a higher top, higher bottom formation, even when the markets are correcting, is generally a good indication. So still a buy at 250, 260 levels.
All right, let's get a move on then and put the spotlight on Patanjali, as the stock exchanges have ordered the freezing of the promoter and promoter group shareholding in Patanjali Foods. This is for not complying with the regulator's minimum public shareholding norms within the stipulated timeline. What are the implications of this? Let's understand a little bit more. My colleague Vinny is here to break it down for us. Vinny.
Absolutely. So, when you look at the total promoter shareholding as of now, they are holding 292.5 million shares, which accounts to 80.82% stake. What the company had to do was bring down its stake and increase the public shareholding to 25%. It is as of now holding, public is only holding 19.18%. So they had to furthermore dilute around 6% of their stake, and the public shareholding would go up by 25%. Now, this is what the requirement they're not met. That is why the exchanges have freezed the promoter shareholding because of this non-compliance with the minimum public shareholding. And in these names, have freezed around 21 promoter and promoter entity groups that have come in, and Patanjali Ayurveda is one of the names as well, which is the single largest promoter shareholder. When you look at it, they hold 39.4% stake. The names like Acharya Balakrishna are also coming in terms of the list of the promoters whose shares are freezed as of now as well. Now, what the company is also given in terms of the clarification this morning, that this freeze will only be applicable in terms of till the company meets with the public shareholding requirement. They are confident of meeting this mandatory minimum public shareholding within the next few months, as well as the stock exchange will not have any impact. The freezing will not have any impact on the financial position, is what they've said and mentioned in the press release that they've given. Keep an eye out on this one. 6% more dilution is required, which accounts to around 2,000 crore rupees that they will be raising from that 6%. So how are that fund going to be used is something that we're watching out for as well.
Okay, we are now joined by the management of Patanjali Foods, Mr. Sanjeev Asthana. Let's take our conversation forward. Mr. Asthana, good morning. Thank you for joining us. The freezing of shares by exchanges is pretty much as per the regulation. So the company might have been aware of this. Has the company applied for an extension of the deadline?
No, we constantly communicate with SEBI, and it's a technical matter where the rules are well defined. And if you don't meet, within a timely manner, this certainly can happen. In any case, just to clarify, our shares were locked in, promoter shares were locked in till April of 23. And so to that extent, it is not that any sales or otherwise was going to be done. Second issue is that, we are very much actively working on further dilution up to 6%. There's a lot of reasonable, response from the investors. But the markets have to be conducive and markets have to support in terms of this dilution. And we are pretty confident it should happen in next couple of months.
Now, as the promoter shares are frozen, the company will have to raise fresh capital. Is the company already looking at doing so? Have you appointed the merchant bankers?
So the investment bankers have not been appointed, but you do know that we've got many investors already. We are starting to talk to a new set of investors. And that also you'll hear very soon from us in terms of the appointment of investment bankers and the mode of dilution that we're going to adopt.
Right. Morning, Mr. Asthana. By when will the company now be compliant with the laws? Is there any specific timeline that you could put to this?
So I think on the outside, certainly before 2 quarters, it'll be done. And we are hoping that it'll be done sooner. But markets have to be supportive and markets have to be in some way conducive for us to go through the dilution.
So is the company already in talks with investors for this and now we're only waiting for the markets to approve?
So we have major investors, of course, and that conversation continues always. I would not be able to divulge the details of the investors, but we have several institutional investors. They are also interested to increase their stakeholding, including the new set of investors, so that we are pretty confident that we should be able to sail through on that. The conditions part is that in terms of markets have to improve and, the situation has to be conducive, as I'm repeating again, for us to go through the process.
So as per our calculations, around 2,000 crore of fundraise is necessary. But does the company need the fresh capital? How would you look at deploying this cash?
So you do know that we've got several both the projects in terms of requirement of the money, probably no, but that is something that we need to go through certainly in terms of the dilution that we need to work on. And, this money would go towards supporting our further investments that we may require, towards the working capital requirement that we have. And as you know that we are a totally debt-free company. So to that extent, we'll have to work towards it. And this money will be a combination. It could be an OFS, it could be QIP. Those details are being worked out.
Okay, thank you so much, Mr. Asthana, for providing that clarification. That's the word coming in from the management of Patanjali Foods. They're in communication with SEBI and they're actively working to further dilute their 6% stake, and they will comply with the minimum shareholding norms. Let's move right on then. It's 9:03, so the pre-open rates have kicked in, and for now, it's no big gash on the screen. You are seeing a mild cut of about 0.2%, but yes, sub the 17,000 mark at 16,930 thereabouts, and for the Sensex, we're down about 330 points. Let's find out our chartist mid-cap strategies for the day then. And Kunal, what is looking good on the screen?
So it's Glenmark Pharma, which has sprung back into some sort of a very strong price action, potential breakout for itself. So over the last 1 month, the stock has been trading up closer to that 420, 430 levels. In the last 2-3 months, when you look at the price recovery, the stock has recovered quite strongly from those 350, 370 odd support, bouncing off from the 200-day moving average. etc. So all the positive aspects were highlighted into the stock price, and now with the stock coming back closer to a breakout in the short-term charts, it indicates that we could see a renewed momentum into this name. So would suggest a buy. 460 could be a near-term target. Stop loss at 415.
All right, there you have it. That's what Kunal is sticking with. Defensives. Naresh, your call.
So continue to be bullish on IEX. The stock has given a breakout yesterday. Continues from that momentum when it started at 138, 140. A fresh swing high yesterday. I would expect it to continue. The volumes are also very high. One of the largest volume ticks in the last 6 months. Expect this momentum to continue towards 170 levels. A stop loss at 145.
Okay, that's the view coming in. Some top recommendations. Meantime, Dipan, just wanted to get in your take on, the fact that a lot of the defensive names as well came under pressure yesterday. Some of those FMCG counters. What is this indicative of, according to you? And do you believe that this is just sort of a temporary phenomenon, or we are seeing some sort of a sectoral churn?
See, I think, when markets are in turmoil as they are, then good quality stocks also do get sold. And a lot of the FMCG companies are owned by FIIs. So if there's concentrated selling coming in from any particular fund, then that will cause a correction. As I said in the beginning, that I don't think the fundamentals of the Indian economy or corporate earnings have been impacted by whatever we have seen in the last couple of weeks or even before. On the contrary, I think the entire oil price and commodity price correction is very positive from an inflation interest rate situation, which I think is the real issue with Indian markets and global markets as well, that interest rates are too high. And that is having an impact on the price to earnings multiple. And once we see an end of this high interest, high inflation regime, then you could see a revival of the bull market. So I don't think that any sector specific correction would have any specific reason for it. I think it's more to do with global markets and the way the trends are and the sentiment is in the domestic market.
All right, Dipan Mehta, really appreciate it. I'm glad you could join us. In the pre-open session, markets indicating that they could be flat, which is not bad news. In the pre-open session, if one looks at the Sensex also, it's not looking bad at all. If we start flat and if we are likely to build up from there, I think that's good news. I mean, considering that 24 hours ago, we were dealing with a Credit Suisse blow-up crisis. Considering that, I guess Asian markets are calm. 1%, 2% is not scary sell-off. In this kind of an environment, the scary sell-off numbers could be sparingly high. I mean, what has happened to crude, I guess, is something which is just a indicator or more like a canary in a coal mine of what financial markets are telling you in terms of where the world is or where the demand dynamics are moving. Crude prices have collapsed. I'm using the word collapse here because it's a fall of about 10%. That changes the macro dynamics for a country like India. You are correlated to global markets, but in the near term, the decline in crude is something which is just going to be adding as a huge buffer point before you're looking at selling. $10 crude in fall in crude, and that is what happens. Current account deficit narrows by $14-15 billion. Retail inflation eases by 50-60 bips. Wholesale inflation could ease by about 1% to 1.25%, and the trade deficit will narrow down by about 12%, subject to the fact that the prices stay where they are and they don't bounce back up. Bank Nifty. Naresh, what's the strategy for the Bank Nifty today?
So the strategy is to hold on to the Bank Nifty and expecting a bounce here from the current levels, and this could go towards back to 40,000 also. So the zone remains this area of 39,000 roughly is the support band. I don't expect it to correct sharply today, but any dips today would be a buying opportunity. So if we go closer to 38,900, that would be a buying zone.
All right, that's the view coming in on the Nifty Bank. Meantime, let's just get a quick take in as well on some of the other large caps that came under pressure. You had something like Grasim, ICICI Bank, Sun Pharma. They were all under a bit of a cloud, but Bharti Airtel was one of the biggest losers in yesterday's trading session. Kunal, a quick chart check at 756 on Bharti.
So it was being a bit more resilient. I think till last week or so, the stock was at 760 plus levels, trading above the 200 DMA and coming very close towards the breakout of the previous swing highs. So I think Bharti Airtel has historically been a very, I would not say a very low beta kind of a stock, but somewhere between low and moderate beta kind of stock, managed to absorb the volatility in the major part of the market trends. Even on the upside, when the markets were doing up or running up significantly higher, the stock remained sideways. So it has its own trend, its own trajectory, devoid of the major market trends. And especially the volatile moves for the indices. So it doesn't come as a surprise that Bharti Airtel is also remaining a bit more sideways at current levels. Now, the two important levels which I would probably keep a watch on for Bharti Airtel to try and decipher that whether it's a trend up, breakdown, breakout for the stock or breakdown. The one would be closer to that 780 mark, which has been a triple top high for Bharti Airtel. So if the stock crosses about the 780 levels, we can expect that probably the stock is getting out of a consolidation on the upside and a dash back towards the life high levels. But on the downside, 740 could be a major support. This was the previous low for the stock in the month of February, from where it bounced off.
All right, let's move right on then. And here are the other top stories to track. Eyewear retail major Lenskart has gone ahead and they've inked an agreement to raise a whopping $500 million from the Abu Dhabi Investment Authority. The company has said in an email statement that the investment will be made through the purchase of both primary and secondary shares. Meantime, shares of Snap and Meta have risen on the back of the Wall Street Journal report, which said that short format video app TikTok faces a potential ban in the US if the company parent ByteDance fails to comply with the Biden administration proposition. Investor optimism has lifted these two stocks in anticipation that the TikTok ban would help them to regain a lot of their lost users. Meantime, amidst the global turmoil in the broader financial system, Goldman Sachs has lowered its 2023 economic growth forecast for the US, citing a pullback in lending from small and medium-sized banks. The brokerage believes that smaller banks will attempt to preserve liquidity in case they need to meet deposit withdrawals, leading to a substantial tightening in bank lending standards. The UK Chancellor Jeremy Hunt has said that the UK economy will avoid a recession this year as the outlook witnesses an improvement. On the underlying growth front, he has added that they expect to grow 1.8% in 2024. And Samsung plans to invest $228 billion in a semiconductor manufacturing complex in South Korea. It's reported to be the largest in the world as part of the South Korea's drive to lead critical technology. And amid the rise witnessed in the number of H3N2 influenza cases in Maharashtra, around 4 cases have been reported so far in Mumbai. The state is expected to hold a meeting tomorrow in the presence of the Chief Minister as well as the Deputy Chief Minister.